$1.2 trillion in a single quarter? I guarantee my old banking buddies are popping champagne right now.
Put the cork back in. Deal volume actually dropped 17%. You're letting Silicon Valley's AI cash bonfire masquerade as real M&A.
Hey, if OpenAI raises a massive round, I'm putting it on my league table. A fee is a fee.
It's 29% of the total. These mega rounds are totally distorting the data.
Which is why we need to strip out the hype and look at what traditional buyers are actually doing. The rundown.
$1.2 trillion. That is the headline number everyone is screaming about this morning. Record-breaking first quarter.
And Tom Miles over at Morgan Stanley is taking a victory lap. He is out there saying this proves M&A is how companies survive tumultuous times.
Nate, you know as well as I do that number is complete garbage.
I wouldn't say garbage. It is technically accurate money changing hands.
It is a $140 billion AI cash bonfire masquerading as M&A. 29% of that total volume is just OpenAI and Anthropic passing the hat around Silicon Valley.
Okay, fair. The traditional deal makers are definitely rolling their eyes in private. Real deal volume is actually down 17%. Strip out the AI mega rounds, and the investment bankers are having a pretty miserable quarter.
Exactly. It is a massive distortion, but we do have some actual traditional buyouts to talk about.
Massive ones. GIP and EQT are teaming up to take down AES Corp, $33.4 billion.
See, now that is a real deal. And ironically, it is still an AI play. The analysts are finally admitting that while AI is nuking software valuations, it is driving unprecedented demand for data center infrastructure. Power is the new gold.
Yep. Antin Infrastructure just bought Sapphire Gas Solutions from Apollo Funds too. Everyone wants hard energy assets right now.
Meanwhile, pharma is just doing what pharma always does. Merck is writing a $6.7 billion check for Terns Pharmaceuticals to get their hands on a mid-stage leukemia drug.
I love a good bolt-on acquisition. Speaking of pharma, keep your eye on the clock. Gilead just extended their tender offer for Arcellx at $115 a share.
The fascinating part of that Gilead extension is the $5 contingent value right. I read the footnotes on that CVR, and the FDA milestones they have to hit are incredibly aggressive. I don't see them paying it out.
A CVR is just a banker's way of saying we couldn't agree on a price, so we invented magic money for the future.
That is entirely too accurate.
I try. But you know who else is hunting for deals right now? Harbor IT. They are publicly stalking the middle market for cyber-focused managed service providers. They want anything with over $10 million in recurring revenue.
Which brings us right back to the software valuation reset. If AI is disrupting traditional SaaS, how do you even price a $10 million software business right now?
That is the trillion-dollar question. Let me tell you what the multiples actually look like on the private side. The big one. $1.2 trillion in a single quarter. I'm looking at the league tables right now, and bankers are popping champagne like it's 2021 all over again.
Put the champagne away, Nate. Did you actually read the breakdown?
I'm a big picture guy, Maya. 26% year-over-year growth is 26%. Tom Miles over at Morgan Stanley is out here saying M&A is the ultimate shelter in the storm.
Tom Miles is doing PR for his bonus pool. Look at the volume. Deal volume actually dropped 17%. This so-called record quarter is a total hallucination.
A hallucination. I see what you did there.
I mean it literally. 4 of the 6 largest transactions this quarter were just OpenAI and Anthropic raising cash. 29% of your $1.2 trillion is just Silicon Valley throwing $140 billion onto the AI cash bonfire.
Okay, but hear me out. If Microsoft or Amazon is dumping $30 billion into a foundational model, that's M&A. It's a shadow acquisition. They get the talent, they get the compute priority, they lock up the tech. It counts.
It absolutely doesn't count. Buying 20% of a company and giving them cloud credits is a venture round wearing a fake mustache. You can't call it M&A just because the numbers are huge.
I can and I will, because the fees spend exactly the same. But I'll concede the traditional market looks a little bleak if you strip out the AI darlings. Software valuations are in a massive reset right now. Nobody wants to buy a SaaS company if an LLM can code its core product in 10 seconds.
Exactly, which is why the smart money is moving to hard assets. Look at the data center infrastructure play. Global Infrastructure Partners and EQT teaming up to buy AES Corp for $33.4 billion. That's a real deal.
Massive deal. Power generation is the new oil. You can't train these AI models without melting a power grid, so owning the grid is the ultimate toll booth.
It's a beautiful structure too. Real assets, real cash flow, no fake mustaches required.
Speaking of real cash flow, we should probably talk about pharma before you completely write off traditional M&A this quarter. Merck just dropped $6.7 billion on Terns Pharmaceuticals.
Mid-stage leukemia drug, clean acquisition, but the pharma deal I'm actually watching is Gilead.
The Arkelix tender offer.
Right. They just extended the deadline for the $115 per share offer. But if you read the filings, there's a highly scrutinized $5 contingent value right attached to it.
Oh, you and your CVRs. You just love a complicated payout structure.
I love seeing what happens when the clock runs out. And the clock on this one is ticking right now. Let's get into the weeds on why Gilead is dragging its feet. Voices.
Tom Miles over at Morgan Stanley is out here doing his best wartime conciliary impression. He actually said M&A historically benefits companies during tumultuous times.
Tumultuous is one word for it. Delusional is another.
Oh, come on, he has a point. Geopolitical uncertainty, volatile markets, that's exactly when strong companies buy weak ones.
Nate, look at the actual data. The headline says $1.2 trillion for Q1. Everyone is popping champagne, but deal volume actually dropped 17%.
Right, but total value is up 26% year over year. You can't ignore that.
I can, and I will. Because 29% of that total value is just massive venture rounds. OpenAI and Anthropic alone accounted for 4 of the quarter's 6 biggest transactions. That is an M&A. That's a $140 billion AI cash bonfire masquerading as deal flow.
See, I disagree with the traditional deal makers rolling their eyes at this. Yes, it distorts the league tables, but market analysts are pointing out the real secondary effect. AI is forcing a massive valuation reset in software.
Which just means traditional software companies are bleeding out.
Exactly. And when valuations crash, private equity steps in. The AI mega rounds are funding the data center infrastructure rush, sure, but the software disruption is what will actually drive traditional M&A next quarter. Those legacy tech companies have to sell.
I'll believe it when I see actual signed purchase agreements, not just banker cope. Right now, without Silicon Valley bailing out the numbers, the traditional M&A market looks incredibly bleak.
Spoken like a true skeptic. But speaking of actual signed agreements with weird fine print, we need to talk about that ticking clock over at Gilead Sciences.
Yes, the Arkelix tender offer. That $5 contingent value right is getting highly scrutinized and time is almost up. Spill the tea?
You have to feel a little bad for the traditional advisory guys right now.
I absolutely do not.
They're looking at this $1.2 trillion headline, best first quarter on record, and they're just fuming. I've gotten 3 texts this morning from former colleagues rolling their eyes.
Because the headline is completely fake, Nate. 29% of that total deal value is just Silicon Valley throwing $140 billion into an AI cash bonfire.
Hey, 100 billion here, 100 billion there. Suddenly, you're talking real money.
But it's not M&A. OpenAI and Anthropic doing massive equity fundraisings isn't a merger. It's a Series F on steroids. Actual deal volume dropped 17%. Real companies buying other companies is actually down.
I know. But you have to admit, at those valuations, an AI mega round is functionally a change of control. You're basically buying a sovereign wealth fund's worth of compute. It counts.
Oh, come on. You're doing the banker spin. You sound exactly like Tom Miles right now.
Morgan Stanley's finest. What did Tom say?
He was out there spinning the geopolitical uncertainty, saying M&A historically benefits companies during tumultuous times, which is just polite banker speak for please do a deal, my bonus is shrinking.
He's not wrong, though. Look at the software space. AI is completely wrecking their traditional business models. Valuations are resetting. You either buy a data center or you die.
which is exactly why GIAP and EQT just teamed up to throw $33.4 billion at AES. Real infrastructure, steel in the ground, not a chatbot.
Exactly. Though speaking of real deals and tumultuous times, we need to talk about a literal ticking clock in the pharma space.
Yes, Gilead is making people sweat with that RSLX offer. Tomorrow's radar.
We need to watch the clock tomorrow on Gilead's tender offer for ARCLX. Time is officially up on that extension.
Right, the $115 a share is fine, but I'm entirely focused on that $5 contingent value, right? It's getting so much scrutiny.
Because it's a massive payout if they hit the clinical milestones. I think they get it done. The market is pricing it like a sure thing.
Oh, come on. Have you read the actual milestones in the filing? They need flawless FDA trial data by next spring. I give that CVR a coin flip chance at best. You're way too optimistic.
I'm just looking at the setup. But look, while we wait on big pharma, middle market bankers are practically foaming at the mouth over Harbor IT.
Ah, yes, the cybersecurity shopping spree.
Exactly. They basically put out a giant neon sign saying they want managed service providers with over 10 million in recurring revenue.
Publicly begging for targets. You love to see it. It's going to be a total feeding frenzy for any founder with 10.1 million in revenue trying to cash out.
Good luck to those founders. Speaking of feeding frenzies, wait until you see the massive infrastructure asset Apollo just dumped